Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey, everybody. Welcome to the podcast. So I regularly get questions from U.S. business owners that are looking to go outbound to Europe. And they come to me with this concept of VAT. And they're like, Mish, what is this VAT or GST? I don't understand this concept. And I have to tell them, well, it's like sales tax, but different. And I thought to myself, we've got the Nexia network. You can see, for those that are watching on YouTube, you can see that everyone, including myself and all the guests today, we've got our Nexia logos rocking hardcore here. I thought, let's get the Nexia network together. Let's get these folks together. Let's get the dream team going, and let's explain to everyone in the U.S. what that means for VAT and how that works and the take on that. So I'm going to pause for a minute. I'm going to kind of kick it around the room here to let everyone introduce themselves. And then we're going to get into some topics related to that so that we can give everyone as we say in the US, the inside baseball on that topic. So first off, let's start with Nick. Nick, tell us about yourself, your firm, and give us a little background.
Thanks, Mishkin. Hi, everyone. My name is Nick Hart. I'm VAT Partner at Nexia Saffery in the UK. I also currently chair the indirect tax Nexia community group. I've been with Saffery 6.5 years. I've been in VAT 21 years, and a good chunk of that time has been spent advising US headquartered businesses on their international expansion from a VAT perspective.
Awesome. All right, Michael, you're next.
Thanks, Mishkin. My name is Michael Salman. I'm a Dutch accountant and tax advisor. I've been doing this for about 25 years. I'm more an accountant than a tax advisor. And I've been into the Nexia network for almost 25 years the same with various firms. Currently, I'm the director at Nexia DHW in the Netherlands and helping worldwide customers or clients coming into the Netherlands and help them with the VAT representation and helping the network if there are any questions in other countries.
Oh, absolutely. And Tobias?
My name is Tobias, and I'm a certified tax advisor in Germany, specializing exclusively in VAT matters since passing the tax advisor exam. Before I joined Nexia 2 years ago, I worked in a VAT office in another large tax advisory firm where I also focused on VAT. Today, I coordinate VAT services for Nexia GmbH in Germany. We operate across 11 offices nationwide with 500 employees. I'm based in our Berlin office, and here we have a strong focus on clients from the real estate sector, but also for retail and the energy industry.
Awesome. Okay. Well, let's get right into it because I'm sure everyone wants to kind of understand this concept. So let's go with a hypothetical. I'm a U.S. headquartered company, and I think we had a chuckle about this when we talked in the pre-meetings. But let's just say I'm developing some kind of facial cream or moisturizer or whatever it is, and I want to get all of that over to my European clients all throughout Europe. So basically, I'm trying to go inbound into Europe, and someone comes by and says, "You know what? You probably need to register for VAT." What does that mean? And walk us through the registration process for VAT. And then what happens if you fail to register for VAT? Like I just decide to go in and I start selling to people. What are the implications that go on there? Start with you, Nick.
So what I would say is, first of all, is in advising clients in these circumstances, it's necessary to understand some of the detail of their intended supply chains. So VAT, obviously a tax that's charged on supplies of goods or services, and there are certain rules which would require US headquartered companies which aren't established in Europe to come and register for VAT in Europe on account of selling goods here. But equally, there are also situations where the supply chain could be structured in such a way as that requirement doesn't arise, and VAT accounting sits with an EU party or European party in those circumstances. So we always kind of start off by needing to understand what the intended supply chains are going to be, what's the structure of those, where the stock is going to be located, who the customers are, what's the platform through, what's the format through which sales will be made, is it through e-commerce, is it through local distributors, etc. Is product going to be sourced in Europe, or is it going to be imported from Asia or the US or wherever? So I think that's always the starting point for us as VAT advisors, is to understand, the intended supply chains. And then if the conclusion is under those situations that the US company has to come and register for VAT, then there's a process in every jurisdiction of filling in an application form and submitting that to local tax authorities to explain what it is you're going to be doing, why you're applying to register for VAT. There's a little bit of scrutiny regarding non-resident applicants, because within VAT systems there's quite a lot of fraud, and tax authorities are quite guarded against that, and have certain controls and processes in place to make sure that when non-resident companies are seeking to register for VAT, it's for the right reasons, and there's actual supply chains going to be conducted. But there's a process to follow in terms of submitting an application to the local tax authorities. That will result in a registration number being issued typically, and it's not until you get your tax and VAT registration number issued that you're allowed or permitted to be able to charge, collect and remit VAT on the supplies that you make.
Okay, and so what I heard there was that you as the distributor have to collect the VAT up front. So you have to collect that from the person that you're selling that to?
So the VAT will, I mean, depending on what kind of supply chain you're in, whether it's a retail or wholesale type supply chain, VAT it's applied to the value of the supply of goods. So in a retail situation, the retail price will include VAT. So the party that's liable to account for that VAT would take out the appropriate percentage of VAT from the gross retail price. If it's wholesale situation, and you're dealing in net values, then you would add the appropriate percentage of the tax for whatever the jurisdiction required that you were operating in. You would add that VAT on top of the net value, collect that from the counterparty to the supply, and remit that to the tax authorities through the submission of local returns.
Yeah. So Michael, a lot of stuff comes in through the Netherlands. Is there a different registration and import process that you have from the UK or any other country?
No, or we have something different. It's called a Article 23 license. That's usually used for companies frequently importing goods into Europe, and we see the Netherlands as the gateway to Europe.
Yes.
In the past, it was the UK, but right now, with Brexit, it's more towards the Netherlands.
Okay.
So using the ports in Rotterdam, Amsterdam, and with that Article 23 license, which UK has the similar right now, you could postpone payment of import VAT towards the final tax declaration. So that does save cash flow. So if you say the goods imported, let's say it's $1 million in the Netherlands, and the goods are falling under the high rate, so it's 21% VAT. If you don't have that Article 23 license, at the moment it hits the port and you want to get it past customs, you have to pay 21% VAT on that.
Oh,
With
wow.
the Article 23 license, you can postpone it to the tax declaration, and there's no cash out, actually, because unlike what I've heard that President Trump is mentioning, is that the VAT is not an increase, it's not an import duty. It's something you collect on behalf of the government, and if it's a company and they pay it towards you, they can deduct it on the tax return. So it should be zero net effect. It's just a financing way. And with the Article 23 license in the Netherlands, you can defer that tax to a later moment. And basically, when you claim it back also, there would be a zero cash out at that time.
Okay, perfect. I like that. And Tobias, what about in Germany? Is there anything different we should know about for Germany?
Yeah, in Germany so far we don't have that Article 23 at the moment, but according to the current coalition agreement of the German federal government, there should be also a clearing model for Germany in the near future, but we
Okay.
don't know when at the moment. So at the current point of view, if you import goods, you first have to pay the import VAT, and depending on your filing deadlines for the VAT returns, it may be monthly or quarterly, you have to wait to get the refund of that import VAT. And yeah, if it's a bad timing for you, you can wait 4 months. So, and then if the financial or fiscal authorities also requests further information, so the import documents and yeah, further documentation that the goods have really arrived and you are in possession of the goods, as then you could wait longer than half a year of the money, and that's a really a disadvantage in Germany at the moment in terms of the import procedure. And one more thing to point out is that for US companies at the moment, we require an indirect representative, and it's hard to find one, as the indirect representative is liable for the VAT and also for refunds and damages, etc. And if you don't have a branch or permanent establishment or whatever in the EU, it could be hard to bring the goods into the European Union or into Germany in particular.
Oh, okay, that's interesting. I didn't realize that there was a secondary liability imposition on an indirect representative. Let's dovetail off of what you just said there, though, because you're basically talking about permanent establishment and nexus, and I think Nick brought up at the very beginning that you got to look at the fact pattern to understand if VAT applies. I assume that there has to be some kind of nexus that would bring you into the VAT equation, right, Nick? So tell us about how nexus, PE, kind of how does that impact the analysis? Are there any best practices or tips to consider, inbound into the UK?
So for VAT purposes, we tend to talk more in terms of the concept of establishment. I know Nexus is a big concept in US sales tax. For us, we talk in terms of establishment, and there are synergies between the two concepts. So we in some ways we're talking on similar lines. But interestingly, for US businesses coming to the UK, it's possible and actually and pretty frequent that the US companies have to register for VAT here on account of what they're doing supply chain wise, even without any presence in the UK. The only presence they may have is their customers and inventory of stock, for example. That in itself wouldn't create nexus. It wouldn't create establishment, but it still would give rise to a US company having to register for VAT in the UK if it held inventory of stock, for example, in the UK, and it was making supplies from that inventory. So there are circumstances when actually the establishment nexus point isn't relevant, and we actually still have a requirement for US businesses to register for VAT here. It kind of depends on, again, going back to the nature of the supply in question. But where establishment can become particularly relevant for VAT purposes is service supply chains. And so a lot of the rules around where a supply of services is taxed for VAT purposes, we call them place of supply rules. A lot of those are based on place of establishment, where you've got nexus, if you like, and that can generally be created, say, for a US headquartered business by having employees in the UK, having some kind of fixed place of business, having an office from which those employees are operating. That would typically create some degree of establishment, which then may mean that supplies of services that the US headquarters company is actually making are being made from the establishment in the UK and not from the headquarters back in the US. So it can create some complexities where you've got that a US company with employees here, with other resources here that have this permanent permanent location in the UK. So those are the kind of things that we think about, particularly in the service sector, as I said, and that can lead to wider issues as well as VAT. So you can have other tax implications, corporate income tax, and obviously transfer pricing matters as well. But from a VAT perspective, it can be, particularly in the service sector, it can be an important concept to understand what you've got in the EU or what you've got in the UK in terms of employees or physical presence, and what that presence is actually doing. What are those resources actually doing from an activity wise? What services are they undertaking? What functions are they performing? So we can have situations where effectively the US company creates an establishment of itself in the UK for VAT purposes by having that presence here, and that can lead to some additional VAT complexities in what would otherwise possibly be a rather straightforward B2B supply chain in some circumstances. So it can be an important issue.
Okay. What about you,
And
Mike?
of course,
Yeah, go ahead.
basically the same. And of course, also if you have staff here or physical presence, it would also mean that you would need to apply for other taxes, so corporate income tax, payroll taxes. So you have to keep that in mind also when we do a permanent establishment evaluation. What does the client do? How far are they in? Also, we'll also in the Netherlands take a look at, do we do it through a permanent establishment or do we set up a local entity? Because one thing Tobias just mentioned on the fiscal representation, with the Article 23 license being a US entity, you would also need a fiscal representation in the Netherlands. That we can do that as a firm, we do it. And the tax authorities would ask for a yearly, for about 5 years, about €5,000 per year as a deposit, as a security, because we would be liable for the tax returns, but it's liable up to €5,000 per year, up to a certain turnover. Above that, it's a percentage of the turnover. And what we do see is that a lot of US companies, but also Chinese, Indian, come through the Netherlands first and then go to Germany because of the disadvantages that Tobias mentioned. And the Netherlands is, I think the Ruhr area in Germany is within 2 hours, 2.5 hours from the Dutch port. So it's closer than coming into Hamburg, going to Frankfurt in Germany to get the goods there.
Yeah, so it sounds like that the pull for, as far as getting into creating an establishment in both those countries is quite broad, and it's easy to satisfy, especially if you have actual, quote unquote, as we say in the U.S., boots on the ground. What about you, Tobias? Tell us about Germany. How does the nexus or the establishment rules work there?
For companies acting, for European companies acting with US companies, it might be more easy to engage them if they are European companies. So it's easier for their compliance reasons, and that's why they often preferred to work with European companies, and if they have a branch or whatever in the European Union.
Okay.
But it's not a tax specific topic. It's more between the business relationship.
Okay, perfect. Let's wrap up this conversation with the VAT and the Nexus, and let's talk about B2C and B2B transactions. Is there a difference in how I'm thinking about that if I'm going to do a B2B versus a B2C kind of operation, kind of going inbound into your various countries, sales or services? You can kind of contextualize it as you see fit. Why don't we kick that off with Nick? Any comments there about that?
So we have different rules. These apply in the UK and the EU. For B2B supplies as different rules for B2C. The reason being is that for tax authorities, it's far easier to identify, a local business in that jurisdiction receiving a supply. So they're much more identifiable, and many rules put the liability for accounting for VAT on a supply onto that local business. It's registered for taxes there. It's much more identifiable and visible to the local tax authorities. So a lot of B2B rules do shift the liability to account for VAT away from the non-resident supplier, the US company supplying the goods or services, and actually put that liability onto the business receiving that supply, which obviously means that the non-resident company in those circumstances wouldn't need to register for VAT in the UK or Europe and collect the VAT. That the VAT is being self-accounted for by the recipient. Now, obviously, in the B2C market, that's not going to be the same position. The tax authorities are not going to go after individuals, are not going to try and identify individuals and have individuals bring VAT to account, unless they are individuals that are operating, sort of sole trade businesses. But
Okay.
consumers are much more difficult, and actually the VAT system is not designed for consumers to be accounting for VAT at all. So the B2C rules, I'm generalizing obviously, but many B2C rules would require a non-resident business to go and register in the UK or the EU, because that would be the right position. They're more identifiable then to the tax authorities, because they are a business and a company rather than just a consumer. So we advise clients that have both. So US businesses trading in the UK and the EU that have B2B supply chains and B2C supply chains. So it's really important that from a kind of internal process perspective and accounting perspective, that they understand, okay, and which are the transactions that are giving me the VAT liability, on which transactions do we need to be the party charging, collecting and remitting, and actually on which transactions is that liability shifted to the recipient. So that's really important, obviously, to make sure that the VAT accounting is correct, that all parties in the supply chain are aware of their reporting obligations, etc. So it can get more complex, for businesses that have both B2B and B2C, and often we can find that a US business may start off in B2B supply chains, going through distributors in Europe, and then actually evolve into a direct-to-consumer model, and so have to adapt and not assume necessarily that the VAT position is going to be the same that they've been used to, and take new advice on what is markedly a different supply chain from a VAT reporting perspective.
And hopefully they've talked to someone before they make that evolutionary step upward, right, or different from what their current model is. They've gotten the good advice and they've set things up properly. Okay, Michael, what about you? Any words of wisdom on B2B versus B2C in the Netherlands?
Or with that, it's the same as in Germany. So it's European guidelines. Usually B2B transactions are typically reverse charged. That's what Nick also mentioned, that I send an invoice to a customer with their VAT number, and then they file the turnover in their tax declaration as being reverse charged, and they pay the VAT, and on the same return they ask the VAT back.
Okay.
B2C, it's we have to register in Europe for, if we're over 10,000 euros in B2C sales, at the local tax authorities for which you have a tax number, and then make sure that when you do sales on, let's say, your website to Belgium or to Germany or to France, you have to mention the country the recipient is in, handle their local VAT percentages, and then file with the, in this case, the Dutch tax authorities, a OSS filing, in which we say we sold in Belgium, let's say 100 with 20% VAT, Germany with 19% VAT, and we pay that to the Dutch tax authorities, and the Dutch tax authorities turn around and pay it to Germany, France, and all the other countries. And that would be the same, for Germany, I would say, Tobias, or am I missing something?
Yeah, it's the same. To the delivery is one thing what should be taken into consideration if I receive some services maybe, and the service is property related in Germany, then the place of supply is Germany and the reverse charge mechanism applies. So, but if you are in a supply chain, need to register for B2B transactions in the European Union. So it's not only for B2C, but in some cases also for B2B cases. But yes, the most common cases might be with B2C, where you have to register if you perform to private individuals, to consumers. As Nick already said, consumers won't file their VAT returns, so any entity have to do it, and therefore you are obliged to file VAT returns in the European Union if you are acting here.
believe it or not, here in the US, at the state level, this is just kind of off topic, but I thought it would be interesting for you guys to know. So at the state level, for individual purposes, you do have to disclose if you need to pay sales tax that wasn't collected up front. So if I bought something off Amazon and I didn't somehow got around paying the Virginia state sales tax on that good, I have to then remit that through my Virginia income tax return. So it's the burden is on the individual there, which is a little bit different than what you guys have to deal with. But going back to the conversation here, Michael, I heard you say OSS, and just talk to me like I'm a 3-year-old for a second. Is that the one-stop shop? Is that what I understand that to be? What is that?
That's the one-stop shop. I think the European Union wanted to get something like your big beautiful bill in there.
I was going to say,
It's one-stop shop to file all the tax declarations from one country for the rest of Europe.
Okay, that's very cool. All right, let's talk about VAT compliance. Let's get into the practical shuffling of papers. We're all accountants here. When are VAT returns generally due? When do I file the VAT? And then I guess a follow-up question would be about VAT invoices, which I understand are kind of a big deal. What should a VAT invoice look like? And what are the record keeping? If someone were to challenge me on a VAT invoice, would I need to provide substantiation documents? Those kind of things. Let's kick it off with Tobias. Tell me about when the VAT filings are generally due, or how are they due, and what does that look like?
Here, it depends on a few things. So the first thing is if you're talking about Germany or another EU member state. So unfortunately, every member state have other deadlines for filing the VAT returns. And
Okay.
the second thing is that in Germany, and I think in the Netherlands as well, we have monthly and quarterly VAT returns. That depends on how much revenue or how much VAT payable you have in the past year. And in Germany, the threshold is 9,000 euro. If you have more VAT to pay, or you have a higher refund, you will have to file monthly VAT returns, and that monthly VAT return is due the 10th day after the month. But it is possible to apply for filing extension. So you can file it 1 month later. So for example, for July 25, you have time until the 10th September to file your monthly VAT return. And yeah,
Okay.
if you have next to these monthly or quarterly VAT returns, you also need to file an annual German VAT return. And this is something what differs to the member states you are talking with. So some only have quarterly or annual VAT returns, and some don't need to file additional annual VAT returns. So you need to go deeper into the member states if you want to have a clear answer on your topics.
Sounds like a good Nexia multi-country summary that we need to get out to everybody. Michael, what about the Netherlands? How does it work there? What am I thinking about when I'm doing my VAT filing?
Yeah, it usually is quarterly. So we do have a threshold of about 10,000 annually. But usually what I see with monthly filings is that you have not been filing frequently, late, or misfilings, that the tax authorities penalize you to doing a monthly tax return. So it's usually it's quarterly. When you start up, it's quarterly. The other thing, and we mentioned the OSS. Another filing in Europe you have is the intercommunitary supply filings. So if I sell something towards Germany and I do the reverse charge, I have to do a separate filing from the Netherlands stating I sold to Germany at the following tax number, the following amount, and that is usually monthly. It starts quarterly, but yeah, I think it's also 10,000 euros per quarter you have to sell. If you go over that, then you have to file that on a monthly basis.
Okay.
So that it's mainly month or quarterly filings. ICL is a monthly filing.
All right, Nick.
And the filing date is the next month.
Okay.
So July 31st is the filing date for the second quarter.
Okay, perfect. And Nick, what about UK?
Yes, we typically file VAT returns on a quarterly period basis. It's not always calendar quarters. You can select a different different quarterly period. But typically most taxpayers are on 3-month VAT filing periods. We have a 37-day deadline for submission and payment where a payment is due. What I would say is that VAT returns themselves are not so complicated in terms of the data that needs to go on them. I mean, I have come across some jurisdictions where the VAT returns are, it always seems to me, sort of slightly over complicated, and you have to separate all sorts of different things out into different boxes and fields, etc. But generally, in my experience, the VAT returns are relatively straightforward. Obviously, we have the VAT that's a liability, so the payable VAT, but obviously within our VAT systems, we have this concept of recoverable VAT, so VAT that you incur on maybe on your imports or your business costs that you can offset. So obviously that gets reported as well, and then we have the net position, which is obviously either a liability or in some cases, a VAT refund is due from the tax authorities, because your recoverable VAT exceeds your payable VAT, and that happens relatively frequently, and it's for perfectly legitimate reasons. The other thing I would say is that the world of VAT filing is evolving globally, and not least in Europe as well, whereby there's a school of thought that suggests the concept of a VAT return, a filing, is being phased out, basically with advancements in technology, and tax authorities are looking at technology to new ways of collecting transactional data on which the VAT is an element of it, and so we're seeing evolution here, and it is pretty quick. I mean, some jurisdictions have had it a little while. We're talking about sort of SAFT audit file submissions to replace your classic return with boxes and on, etc. So it's a bit of a fluid environment, to be honest, and it will evolve further as technology evolves and tax authorities think of ways to use technologies, because I've mentioned earlier we have an issue with fraud in VAT systems, and tax authorities see technology as a way of tackling that, and almost in some cases having real-time or near real-time visibility of transactions taking place. So technology has a big role to play in that. So it might be that, if we were talking in 5 years' time and you asked me the same question, what a VAT return would look like would potentially be markedly different to what it looks like now.
Okay. Do you see like the artificial intelligence functions maybe coming into play with the SAFT or the e-invoicing? Do you see that being the next evolution there, or are the tax authorities kind of still hesitant to use those functions in that area?
I think AI will play a part. Of course, it will, as it will play a part in our lives on a day-to-day basis. I think there's an adoption there, and tax authorities are alive to it. Obviously, from their perspective, what they don't want is a constantly shifting environment where businesses are struggling to keep up and to comply because things are evolving so much. So there has to be a point of settled state that you can implement a new system locally, and businesses can prepare for that and change their processes and their own technology and software to deal with that, train their own people, etc. So it will be adopted. I just think from a tax authority's perspective, and being very conscious of not hindering business in what business needs to do, because obviously that has a knock-on effect to the wider economy, is getting to a point of some degree of settled state and saying, right, this is what we're going to land on, and this is what we want to implement, and therefore, that to a degree will evolve over time, but there needs to be a point in time where we say, right, this is what you need to adopt in your processes to be able to comply from that perspective.
Mishkin, what you do also see is a bit more what some of your listeners and viewers might have, is the Mexican way. Is in Europe you're getting the PayPal network, which is basically I send my invoices towards a service provider, maybe government. They sign off on the invoices and send them towards our clients. So the blockchain system might be in there, coming in, and they will collect the VAT that way, and there won't be any. If I send it out, someone else gets it in, it matches. So it might go a bit more towards that way. And I do see that a bit in Eastern Europe. We saw it with our Mexican friends when we were in the last conference, we were doing invoicing, and they're showing we're doing it this way. So the IT systems of, I would say, the Western European countries might be a bit more outdated and not as flexible towards those kinds of systems. But Belgium is pushing towards the PEPL network. The Netherlands is going there. And correct me if I'm wrong, Tobias, but I think 2030 or 2035, the PEPL network, or this has to be implemented in the rest of Europe, or?
I'm not sure on the correct date, but yeah, we are now starting with the e-invoicing in Germany, or we already started in the first step. So the companies, but it's only for German local companies, have to accept e-invoices. What is not a PDF, it's more a specific data where all invoice information are included. So Mishkin, you earlier asked for the invoice information. This is the
Yes.
name, the address of the performing company, the recipient, the VAT rate, the net amount, the gross amount, the type of service or supply, the date of supply is important, invoice date. So there are a lot of information that have to be included in the invoices to be allowed to deduct the respective input VAT. So therefore, the invoice requirements are always a hot topic in VAT and in VAT audits as well, that needs to be taken into account. But with respect to the e-invoicing, we are now at the start. So as of January 25, you have to accept these e-invoices, but it's not a must have to issue that kind of invoices in the next 2 years. So as of 2027, huge companies have to issue these e-invoices, and 1 year later, all companies have to issue these invoices. But in comparison to Poland or Italy, or what Michael already said, in Germany, it's not intended yet to send these e-invoice to the German fiscal authorities that they can check the information, but you only send it to your customer. So it's nothing the German fiscal authorities can work with at the moment, but I think it's just a matter of time when this will also change in Germany.
And what about the record keeping requirements there, Tobias? I mean, you described what goes into an invoice, but if someone were to come back, like Nick said, there's a lot of fraud floating around with this stuff. Someone comes back and wants to challenge an invoice or a VAT amount. What are we producing? What's the client need? Do they need to produce something to back that up, or is it collected through your firm, or what would they be looking for there?
Yeah, you have to record the invoices in the same form you received it. So if it's a printed invoice, you have to keep the original printed one. If you got it via PDF, you only have to keep the PDF document, and you have to keep it for 8 years. It's also new as of January this year. Earlier we had a 10 years time to save the invoices, but now it's 8 years. So, and the 10 years time was corresponding to the time the tax audit could be back or go back in cases of VAT fraud. And that's why you have to keep the documents that long. But now we have 8 years. It's still a long time.
Yeah, no, that's a very long time. Which leads me into my next question. And I always tell people I love when clients always come to me before they do something, and then you could properly advise them and get them set up. But everyone on this call, I think we all know that doesn't always happen in reality. Sometimes clients just run off, they either get bad advice or they run off and do something with bad assumptions. And so what happens if client comes to you and says, "Hey, look, I didn't file my VAT filings on time. I didn't know I had to. I didn't even register for my VAT number. I need to get back, or maybe I did my invoicing incorrectly. Like, Tobias just listed, 10 things that need to be on the invoice, but I just basically put, VAT due X, and that was it. I didn't give any other details, right? So now I need to go back and make a bunch of corrections, updates. I need to maybe fall on my sword to the local tax authorities. What do we do to, as they say, unravel Gordian's knot? Let's start with you, Nick. What have you seen in this area? I think you've seen a lot of this stuff. What's your general take? How do you proceed?
So it happens more often than ideally it would happen. So, and then it just arises because, US businesses coming over to Europe, they don't necessarily take advice at the right time, and they're not necessarily prepared as they should be. But I think there are mechanisms to put things right. And it kind of depends which mechanism you use or which approach you take. It depends on kind of how things have gone wrong. In some instances, it can be a little bit painful, and it can. Taking the example of the OSS that Michael mentioned, the one-stop shop. Technically speaking, you should, if you want to use the one-stop shop, you should register for it when you're liable to. You can't register for it retrospectively, and the alternative to one-stop shop is you have to go and get registered in every member state in which you're selling to consumers. So trying to fix a situation retrospectively where ordinarily we would have recommended OS at the start, and that's the most efficient way to manage the VAT compliance. You're faced with a situation where you're telling a client, well, the only way to do this is to go to each individual member state. So that's quite a painful and expensive process. There are other circumstances where, yes, VAT has been underdeclared. There is in the UK and typically everywhere else, there is a process for disclosing that error to the tax authorities. Some tax authorities are more open to discuss that than others. Some take a hard line. Some are more pragmatic view in certain situations. But there's usually a process by which you disclose your error, and you can do it in such a way as to help attempt to mitigate the risk of interest and penalties. But obviously, interest and penalties on any underdeclared VAT is a reality, and they can sting. Interest rates will depend on the country. The penalty regime will depend on the country. We don't have a uniform penalty regime across Europe, so it's very jurisdiction specific, and in some cases they're pretty harsh, and rightly so. And there's often a tiered level of penalties depending on the level of non-compliance, if you like. So there are remedies, there are solutions, there are mechanisms to fix things, but it's not necessarily always a smooth ride. And it's, as well as the actual liabilities to settle for the tax itself, there is often interest and penalties that will arise as a result, and they can hit quite hard.
Okay. Michael, what about Netherlands? Is there any room for negotiation? Any amnesty programs?
What we usually do is take a look at what happened. So go back to the source, take a look at the transactions, and then come to the client with what the tax returns should have been. And then usually we contact the tax authorities. We have to file it ourselves, preferably before the tax authorities get wind of it and go investigate you, because then you do have the penalties. And then usually plead ignorance, saying the client came in, we are involved at the moment, and fall on the sword, basically giving them the tax declaration saying we wanted to pay it, please give us the tax assessment, and then try to avoid the interest or the penalties by giving a plausible case why it's there. If it's European transactions, so Tobias talked on what needs to be on an invoice, and a thing that needs to be on an invoice, if we do the reverse charge mechanism, is the VAT numbers for, let's say, Belgium, or when we got an OSS, we have to file it. With Nexia, we then do go to the core group, which is Nick, Tobias, and then take a look which other countries we can or need to get involved. One of the cases is we've got a huge seller through Amazon, which imports the goods through the Netherlands, sends them to Germany, and from Germany they've got the pan-European contract, which means that Amazon ships the goods to France, Spain, Italy.
Oh wow!
Because we follow the goods, in Europe you have to apply for tax numbers in those countries, and then Germany has a few harsh points in that if you don't have a VAT number in one of those countries, that German VAT also applies. And then we try together with, let's say, Germany, with the other countries, to get the tax numbers done. It's going to be costly also for us to help them, but it's less costly than that the tax authorities come and say, okay, here's $1 million in VAT we want coming in, and then France says we also want the same million, so the double taxations, and maybe Tobias can tell a bit more about this Amazon, because it's a quirk that Amazon has. And yeah, I would say a lot of Americans fall, or European or clients coming in to Europe using the Amazon network can fall into that trap.
Sounds like a trap. Yeah, Tobias, give us the goods.
Yeah, a big trap in this case might be the pan-EU procedure from Amazon. Yeah, as at the moment it is not possible to use the one-stop shop procedure if you have a warehouse in another member state. So you only can use the one-stop shop if you sell goods from your German warehouse, and you can sell it all over to all member states, to Poland, to Slovenia, etc. But if you click on Amazon that you use the pan-EU, then Amazon will send goods to Poland, to Slovenia, to France, etc., to make the prime delivery possible within 1 day. And the problem is that your goods are in Poland in the moment a Polish consumer purchases the goods. And therefore you have to declare a Polish sale. And
Okay.
then you can't use the one-stop shop procedure anymore, and you have to register. And depending on the member state you are missed to report these transactions, it could be very, very expensive. So we had some cases with Italy. It is the most expensive member state so far I've seen. There are penalties up to 150% of the VAT amount. And if you have 1 million of VAT to pay for the past year, it's 1.5 million on top. So I couldn't believe it because in Germany we have only 6% of late filing penalties, or of the corresponding VAT amount. But there are some member states where the penalties are very high, and that's why all the clients should get in contact with their European tax advisors in advance if they want to act with pan-EU or whatever, and to clarify that there's no risk of double taxation. What is if you cannot zero rate your intra-community supplies? So if some goods have been sent from Germany to France, for example, and you don't have a valid VAT ID number in the moment of the transport of the goods, you're not allowed to zero rate these transactions. And the German tax authorities are very harsh to bring it to a zero declaration if there is no way to reschedule the VAT ID number validation in France, for example. And that's why you should also be in time if you start these kind of transactions.
Yeah, I mean, to me, it sounds like there may be some upfront pain to get everything set up properly, but it will pay off long term because you'll avoid some of these draconian. I mean, I was just flabbergasted by some of those penalties you just threw out at us. Sounds like it's very, very punitive. Let's wrap up here. I want to talk, this one's for you, Michael. I want to talk. Just tell us about the Nexia network, because it sounds you mentioned you said we go to the core group, and it seems like you guys are the core group. I said you're the A team when we started off the podcast, but tell us, like, okay, I'm a client, and Nexia is a pretty massive network. We get firms all over the world. We help each other out a ton. It's a great opportunity to, especially if you're going into multiple countries, to get really good combination tax advice. Tell us about how the Nexia network can help with this. Tell us about kind of the approach that we have going on with your group, and maybe give us some pointers on best practices or things that you want the audience to take away.
Now we're looking at various options on that. Usually, where does the client come in? In this case, we're talking more to a US Canadian basis than others. So we do a lot of work within the Nexia network. A month ago, we had a conference in Toronto. Prior to that, I went to the US, went to New York, and visited a few offices there. Did this presentation also on VAT, and telling them, okay, if there's anything, if a client comes over, let us know. If they come over, I've got Tobias and Nick on a short line. So if I got a client coming over to the Netherlands and I know they're doing the Amazon pan-European, I'll call Tobias. If they're going to the UK, I will refer them to Nick. And if they do any other countries, I will try to use Nick and Tobias. Okay, guys, we've got a person coming in to Spain? Who do we call in inside the network, and who can help us with the things? And we know already, because we've been doing this already for a certain amount of years. We know what kind of information they need, who to tie into, how to connect them. We try to give a single point of entry into Europe, but yeah, that will grow gradually towards, okay, I know Michael in the Netherlands, know Nick in the UK, Tobias in Germany, we know Encarni in Spain.
Yep.
And we grow that way towards servicing the client with a single point, and not going towards another advisor. It's all within the Nexia network, and that does so it's like a family. We know each other personally, we know who to contact, where to go, and because we're already doing this, we already know what kind of information they need, and that would help clients coming into the Netherlands or towards Europe, to the UK. Okay, I'll talk to Nick in the UK, and I'll need to go to Europe, and he knows Michael, so he will inform Michael on these things. I'll jump in a call, and then we try to help together to make sure that the client services the best way we can as the network.
Yeah, I mean, that approach is very common to what I always tell people at the Wolf Group. I'm from the US side. I'm kind of like Grand Central Station. People will come to me and say, I need X, Y, or Z. And if I can't help them, I'm directing them up to Christina at Cohn Resnick, or over to Maureen at Gish Seiden. And, the US coverage, it's, you got to kind of figure out who's doing what and who can help out where. Any concluding remarks, Tobias? Anything else you want to add on top of what Michael just said there, related to the VAT offerings that Nexia can provide?
Michael already pronounced that we have a good network, and especially the VAT team knows ourselves very good, as we are meeting in a few meetings a year, or as often as possible. And there are some member states where we have VAT teams, and especially in smaller member states, you need to know that the tax is not that complex that maybe in the UK or Netherlands or in Germany. And then we don't need specific specialists on VAT, so we have one person fits most topic in this kind of member states. So, but we have a network there, and I already worked with a lot of member states for several clients, and it worked very well. So I'm always looking forward to have this cross-border working with Nexia, and I'm looking forward to do it with our US clients as well.
Absolutely. All right, Nick, bring us home. What last words of wisdom do you want to supply to our audience?
So I think one of the advantages that we have to a degree is that we have the single market of the EU, and we have this overarching VAT legislation, and so there's rules that apply across 27 countries. At local level, the compliance is slightly different, implementation is slightly different, but some of the core principles are set across 27 countries. So we can have initial calls and discussions with US businesses about what you should expect. If you want to do X, Y, and Z in Europe, this is what you should expect, and this will apply to these 27 countries here. And that's a huge market, and that's a huge advantage that we have, that we can do that, and then we can set them off, and then we can start to bring in local specialists, talk about the local compliance, etc. And it's fair to say, the UK left the EU. We all know that, and we are, a lot of our rules are still largely based on that EU VAT directive. We haven't diverged massively away from that as yet, but we are not part of the single market. So we do find US businesses say, well, we want to go into Europe. The UK is a massive market, consumer market for us. We need to go into the UK, but we also recognize that those 27 countries there is also a massive market. So we find that they want to do both. They want to go to the UK. They want to have a 3PL in a third-party logistics provider, for example, in the UK. They want to put inventory into Europe. They want to do both, and so we have to tie it all together. We have to, we can have those initial conversations, any one of the three of us, really, from an this is what you'd expect, and then we start to pull in the local expertise as and when needed. So it's a pretty powerful network that we have, and because of that, we're able to really add value and benefit to to the US businesses coming over here.
Awesome. Well said. So just to conclude, guys, for everyone that's listening, this is the VAT download. I think you've got some really good nuggets of information in this podcast. I will be linking the profiles for Nick, Michael, and Tobias to the show notes. We also have a PowerPoint presentation that they've kindly provided to us. We'll link that as well. And certainly, if you have any questions or items that you want to talk to them about, you can link to them directly, or you can always contact me at the Wolf Group, and I'm happy to make an email introduction and participate as needed. So I want to thank our guests for coming on today. That was fantastic. I know I learned a lot, and hopefully the audience learned a lot as well. So thank you so much, everybody.
Thank you.
Thank you, Mishkin. Thank you all.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.